Good day, everyone. My name is Yusuf Said, and together with Group 9, we will be presenting a going private transaction involving the acquisition of Churchill Down Incorporated. First, we're going to discuss the executive summary, and then introduce Churchill Downs, and then go in an overview of the industry, company, our investment thesis, and the firm's financial standing. And then we will discuss the proposed transactions as well as any risks, all the risks associated with the transaction. So to start off, our transaction involves us purchasing Churchill Downs for 14 times EBITDA at $270 per share. This will be financed through a 43% debt at 8% equity with a declining interest rate schedule over 5 years, with an anticipated exit value of $19 billion. We intend to achieve this exit value through three main avenues, which is improving overall operational efficiencies, expanding organically into other states, as well as expanding into the esports sector. To provide a brief history of Churchill Downs, it was founded in 1872 by Colonel Lewis Clark. Through that leadership, it became one of the largest horse racing and gambling institutions in the United States, and it has also developed one of the largest online gambling platforms, also known as TwinSpire. They're also known for hosting the historic Kentucky horse racing derby. Now to pass it off to Ozzy to discuss the industry overview.
Thank you, Yusuf. I will present you with our industry analysis for the two industries that Churchill Downs operates in. We utilized the Porter's 5-force analysis in order to identify the attractiveness of respective industries. First, looking at the horse racing industry, we see that suppliers have a moderate bargaining power. Wholesalers of beverages and foods and advertising agents extract relatively low value from the industry. Yet owners of horses are able to extract value from horse racing companies, as horse prices vary and can be very expensive for the best horses. Next, we believe that buyers have also a moderate bargaining power. Since horse racing facilities are far between, non-gambling fans cannot effectively bargain on the ticket prices. However, gamblers are able to extract value as they mitigate between horse racing facilities and place bets in facilities with the best odds. Next, we believe that there is a low threat of new entrants in the industry. States where horse racing is legal are heavily regulated. There is extremely high competition to obtain the licenses in the industry. The initial capital requirements for building racetracks are also very high, which further complicates entries for companies. The level of competition within the industry is moderate. Horse racing companies compete to obtain the best horses for the races and provide best service offerings as they try and reach younger generations. However, due to a limited number of elite venues across different states, geographics mitigate a part of competition. Lastly, we believe that the industry faces high level of competition from substitute products. Younger generations are more attracted to watching and gambling on other sports. Lotteries, casinos, and online wagering are also growing in demand, hence implying high competition from other forms of entertainment. Now, we have identified numerous industry tailwinds. First being high barriers to entry. The high level of government regulations keep the number of companies in the industry relatively fixed and protect revenues of existing companies. Second tailwind is growing captive demographic. The main customer base of horse racing companies are male adults who are aged 50 and older. This segment is expected to grow in upcoming years, hence growing the demand for horse racing events. Furthermore, we expect excess per capita income to be another tailwind of the industry. This factor is an essential determinant of consumer spending, specifically on gambling and leisure. We expect this component to grow as the economy continues to recover from pandemic. On the other hand, industry headwinds include young generation apathy. This demographic seems to be unwilling to become more involved in the industry. High competition from substitutes pose some concerns for the industry in the long run, as well as the ongoing shift to online entertainment. Overall, we believe that this is an attractive industry which is currently positioned for growth. However, we believe that in the long run, the industry outlook will depend on how well companies will be able to attract younger consumers. Now, moving on to the casino and online gambling industry. We first note that suppliers have a moderate bargaining power. Slot providers and platform developers can extract value from companies as they are the ones producing new games, machines, and platforms. Other suppliers, such as equipment, beverage, and food providers, extract little value. Buyers have high bargaining power in the industry. Gamblers are able to choose among several online platforms or in-person casinos and identify ones with the best payout rate and odds. Gamblers also look at the scale of amenities available at casinos and choose ones to attend. There's a low threat of new entrants in the industry. High capital expenditures are required to set up physical casino facilities and online platforms. The industry is heavily regulated, and operations of casinos and online gaming websites are illegal only in certain states. Companies need to obtain licenses to operate in the industry. We believe that there's a low threat of substitute products. While there are plenty of entertainment activities available, the gamification and adaptation of gambling in many activities has increased the reach and demand for casinos and online wagering. An example of exponentially rising gambling subcomponent is esports. The rivalry within the industry is high. Casinos compete to provide the best services, game offerings, and odds. There are extensive marketing campaigns and promotions in order to increase customer base. Differing tax rates and license fees raise competition further in certain states. Moving on to the tailwinds and headwinds of the industry. Firstly, high capital requirements and license requirements for new companies protect existing companies in the industry. International and domestic tourism further promote demand for casinos and online wagering. As certain consumers live in states and countries where activities of such entities are illegal, they're highly incentivized to visit them once they travel. Furthermore, gambling has expanded its applications to entertainment activities. Most recently, this happened in computer games. This trend is expected to continue. On the other hand, extensive regulatory environment in the industry makes it hard to obtain licenses in new states, making it harder for companies to grow presence in US. The race for customer base acts as another industry headwind, as companies have to constantly increase costs by expanding their offerings to maintain customer base. Overall, we believe that this is an attractive industry which is currently positioned for growth, and overall, this industry is positioned for long-term growth. I'll now pass it off to Vishil.
Thanks, Alex. So as mentioned earlier, Churchill Downs primarily operates in three broad yet overlapping segments, which include live and historical racing facilities, casinos, and their prized and highly acclaimed online wagering app, TwinSpires. The firm originated from horse racing and continues to capitalize on the horse racing segments and prize attraction, the Kentucky Derby, which is known as the two most exciting minutes in all of sports. In this segment, the Derby serves as their biggest asset and competitive advantage that is sustainable long-term and is what separates them from their competitors. The event provides a unique, sophisticated, luxurious experience, and its heritage and history make the experience a lot more iconic and irreplaceable, and thus brands the firm accordingly. Horse racing is also a sport that isn't easily adoptable for any startup firm in the gambling and entertainment industry, as it requires substantial upfront capital and maintenance costs, as well as use of land, which comes at a high opportunity cost. Churchill's management are incredibly organized in sustaining and enhancing the prize segment by recently announcing $135 million worth of renovations to the track and spectator area for the Kentucky Derby. Next, Churchill successfully leverages their existing horse racing and derby fan base through cross-selling historical racing machines at their gaming facilities, traditional casino facilities, and through their online wagering app, TwinSpires. TwinSpires is one of the most largest and most profitable pari-mutuel wagering platforms in the country, but its key advantage being how easily linkable it is to the Kentucky Derby to attain new customers annually. Their ability combines both facets into a single venue or an app, provides clients with its unique experience and promotes customer retention and lowers customer acquisition costs. The casinos and gaming facilities are tailored to cater towards a local customer demographic. They also operate in a tightly regulated industry that often prohibits such entities, which may make this a competitive advantage, yet a little temporary. Their TwinSpires app can be limited or can be imitated, however, not replicated entirely, as large portion of their customers are driven to the app through the Kentucky Derby. Lastly, management has also taken a significant investment towards renovating and expansion of the Derby city gaming facilities to develop and better complement the Kentucky Derby. Furthermore, we see that Churchill's performance remains stable with respect to the pandemic and see the shift in revenue from its Churchill Down racing sectors and gaming facilities, and is offset by increased revenue from online wagering segments such as TwinSpires in 2019 to 2020 during the pandemic. This displays the firm's versatility and diversification in revenue for unforeseen circumstances. The charts also display the gaming segment to be the most profitable segment, which suggests that further expansion in the segment could be made to initiate further growth and profitability against competitors. Next, when compared to its leading competitors, who are Caesars Entertainment, Penn National Gaming, Boyd Gaming, and Wynn Resorts, who all offer a similar product and portfolio of products and services, we see that over a 5-year period, Churchill tends to outperform via EBITDA margins as they retain a higher portion of their profits from net revenues. They are also a lot more stable in return on equity and asset turnover ratios, which displays efficiency in operations and asset use. However, they tend to underperform via gross margins, as this can be attributed to fewer high profit segments relative to their competitors, but this leaves room for improvement done through a potential private equity investment. I'll now pass it off to Kevin to talk about the investment thesis.
Thanks, Vishil. To add value to Churchill, we plan to improve our operational efficiencies by cutting costs, encourage organic growth by working to increase market share, and expand our demographic reach by improving outreach efforts. Because we are already heavily invested in long-term projects, we believe that investments in more efficient processes will lead to higher return on assets and lower costs. To accomplish this goal, we want to push for the expansion of online gaming in the TwinSpires segment. Online gaming presents wider profit margins, and a heavier weight of the segment will help improve our overall firm's margins to be more competitive in the industry. And I'll pass it off to Alex to further discuss our investment thesis.
We believe that the company has multiple organic growth opportunities available. To start, there's potential to enhance top-line growth for the horse racing segment. Yearly demand for Kentucky Derby tickets exceeds the supply. Ticket revenues appear to be the largest component of revenue for this particular event. There's potential to enhance guest experience by providing a larger variety of offerings, which would permit for further price differentiation between tickets. Furthermore, expanding path for Road to Derby, which are a number of races where horses have to compete in order to qualify for Derby, will also enlarge the customer base and wagering pool amongst all the horse racing events. Moving on to the growth opportunities in the casino sector, we first note that the company has a diversified portfolio of 10 casinos across 8 states. There are 10 more states available for potential ventures, which generically provide an opportunity for growth. On 18th of November this year, the company received a new license for casino operation in Western Indiana, which shows that the company is willing to grow its presence nationally. Hotel casinos have become an attractive solution to differentiate amongst competing casinos. We believe that there are possibilities for hotel constructions which will attract tourist customers towards Churchill Downs casinos, therefore raising the overall revenues for brick-and-mortar casino segment. Furthermore, we believe that Churchill Downs management team possessed the necessary expertise to develop on the recently launched TwinSpires. Promotions through partnerships for the best horse racing events provide an inexpensive approach of expanding customer base. Additionally, untapped online gambling markets in West Virginia and Delaware provide opportunities for expansion of the online platform. Now, the growing popularity of esports presents an unexploited opportunity for expanding demographic reach of Churchill Downs. The competitive gaming industry has been exponentially growing in the past 5 years, with COVID pandemic giving it an additional boost of popularity. Going into 2021, researchers had estimated that the only traditional sport which would surpass esports in viewerships in the US would be NFL. The average age of esports viewers is 30 years. Now, we believe that esports provide an ideal pathway to access this younger audience. There are numerous esports teams who participate amongst a variety of different gaming tournaments. We believe that sponsorship agreements with selected teams could highly benefit marketing campaigns of Churchill Downs. Fans would use TwinSpires to place bets on esports events, increasing the wagering pool of the website and allowing for the top-line growth. This allows other segments of Churchill Downs to get exposure and acquire new customers throughout horse racing, casino, and online wagering segment. Now I'll pass it off to you.
Thank you, Alex. Looking at the income statement, we can see that management has done a really great job at managing the company over the last 5 years. This is especially true in the last 2 years when you look at how they've managed to recover from COVID-19. Over the last 5 years, they've been able to maintain gross profit margins at around 28%, and the firm has exceeded pre-pandemic revenue levels by a significant amount. This is also seen in their net income statement and their net income, as they've managed to recover from the negative $81 million loss they incurred last year. This is mainly due to relaxation of COVID-19 measures, which have allowed for tourists to splurge the excess savings that they've held on to throughout the pandemic. A brief look at the balance sheet lets us know that the firm has done an excellent job at investing in itself in the long term. This has come at the expense of some liquidity. However, they've recently announced that they are planning on building an $80 million facility in October. They have also disposed of a $197 million property. And we've seen that over the last 5 years that they've been consistently investing in their PPE and long-term assets. So now to the transaction at hand. So our proposed transaction is a 14 times the EBITDA purchase price at $276 per share. This adds up to $4.5 billion in debt, which is roughly 6 times debt to EBITDA, as well as a $5.9 billion equity investment from our investors. We project a 26% IRR with a 3.19 equity multiple. And looking at our base case, we forecast that revenues are expected to grow at 6% for the horse racing segment and 7% for the casino segment. These figures were derived from a comparison of the average industry 5-year revenue growth rates, as well as the competitors' sustainable growth rates. However, due to a lack of publicly traded firms in the horse racing industry, we have had to use management judgment and estimation to forecast the growth for that segment. However, but even when we look at our base case, we see that even if we forecast that there will be no growth in the industry and at an inflation rate of 3%, we see that the IRR is roughly 19% with a multiple return of 2.43%, which is a very lucrative investment for our investors. And at our best case scenario, we forecast a 32% IRR with an MIC of 4 times. And now to pass it off to Kevin to discuss the risks and mitigating factors.
Thanks, Yusuf. The risks primarily revolve around the ongoing global pandemic, which has adversely affected Churchill's business. Under negative economic conditions and persistent levels of elevated unemployment, consumers' disposable incomes and therefore demand for entertainment and leisure activities decreases. COVID has also presented increased risk for work stoppages and other labor problems that could negatively impact our future plans and limit our operational flexibility by significantly increasing costs, among other operational disruptions. Churchill Downs may also be adversely affected by changes in consumer preferences, attendance, wagering, and sponsorships. With growing concerns over ethical and sustainable business procedures, we have become wary about the reputational risk related to the treatment of horses, with recently raised concerns over the widespread drug abuse by trainers. According to industry sources, parimutuel handling had declined on average 4.6% per year from 2008 to 2014 due to the above raised concerns, as well as increased competition from other wagering and entertainment alternatives. If interest, attendance, or wagering in horse racing is lower in the future, it may have a negative impact on revenue and profitability in our Churchill Downs segment. To combat the previously listed risks, we offer several mitigants that have or can be put in place to reduce net risk. Focusing on COVID-related risks, precautions have and will continue to be taken to ensure public health and safety of all our shareholders. To combat prevailing labor risks, we should focus on attracting and retaining highly qualified and skilled personnel to improve our ability to successfully develop, operate, and grow our business. Over the past year, we have also shut down several of our in-person facilities for months on end to preserve a business environment that our customers and employees would feel comfortable returning to. The ever-changing political and ethical climate has looked downward upon horse racing as a potential source of animal abuse. With our flagship events being a core component to our culture and history, we should focus on increasing regulation and controls around the treatment and care of our horses rather than divesting at this moment. As indicated in our investment thesis, we will also continue to invest and develop in the TwinSpires and online gaming segments, which can hedge against decreases in consumer demand for in-person events while also increasing our margins. This will allow us to keep up with the growing interest from technologically savvy and generally younger customers who may seek opportunities apart from our traditional offerings. We feel it would be appropriate to analyze and compare standalone hotel sections of 3 existing casinos. This would further analyze how efficiently the hospitality component of our company is being run, which is important in understanding how to attract towards Churchill Downs casino hotels. Many of our competitors are private, and the lack of public information results in vague forecasts and poor comparable key ratios for Churchill Downs. Further analysis of future prospects of sustaining operations of all horse racing tracks would help analyze future risks and offer a possible case for a divestment opportunity. To recap, in our going private transaction, we will purchase Churchill Downs by financing through a declining interest rate schedule over 5 years with an anticipated exit value of $19 billion. This value can be achieved by improving operational efficiencies, expanding organically into other states, and further accessing esports wagering. Thank you for listening, and this concludes our presentation.